Introduction. In financial accounting, two of the most fundamental categories in the balance sheet are assets and liabilities. These represent what a business owns and owes, respectively. Proper accounting for assets and liabilities is crucial for presenting a true and fair view of a company's financial health. This module delves into definitions, classifications, measurement, recognition, and valuation techniques used in tracking assets and liabilities under widely accepted accounting frameworks such as IFRS and GAAP.
What are assets? Assets are resources controlled by a company as a result of past events and from which future economic benefits are expected to flow to the company. Types of assets. Current assets, short-term, expected to be used or converted to cash within 1 year. Cash and cash equivalents, accounts receivable, inventory, prepaid expenses, marketable securities, non-current assets, long-term, property, plant and equipment, PPE, intangible assets, e.g., goodwill, patents, trademarks, long-term investments, deferred tax assets.
Recognition and measurement of assets. According to accounting standards, an asset should only be recognized when it is probable that future benefits will flow to the entity. The cost or value can be measured reliably. Measurement bases: historical cost, initial acquisition cost, fair value, current market value, net realizable value, present value, discounted future cash flows. Example: a company buys machinery for 2 million naira. This is recorded at historical cost. Over time, depreciation is applied to reflect wear and tear. Depreciation, amortization, and impairment. To reflect a more accurate value of assets, depreciation applies to tangible fixed assets, e.g., buildings, machinery. Amortization applies to intangible assets, e.g., patents. Impairment occurs when an asset's market value drops below its book value. Depreciation methods: straight line method, declining balance method, units of production method. Example: a 100,000 naira asset with a 5-year life will be depreciated at 20,000 naira per year using the straight line method. What are liabilities? Liabilities are present obligations of the enterprise arising from past events, settlement of which is expected to result in an outflow of resources, usually cash or assets. Types of liabilities: current liabilities, payable within 1 year, accounts payable, accrued expenses, short-term loans, taxes payable, unearned revenue, non-current liabilities, payable after 1 year, long-term debt, e.g., bonds, lease liabilities, deferred tax liabilities, pension obligations. Recognition and measurement of liabilities. Liabilities are recognized when there is a present obligation resulting from a past event. Probable outflow of resources will be required. Amount can be measured reliably. Measurement bases: historical cost, amortized cost, fair value, present value. Example: a loan of 5 million naira due in 2 years is recognized as a long-term liability and may accrue interest at an annual rate. Contingent liabilities. These are potential obligations depending on the outcome of a future event, e.g., lawsuits, product warranties. Accounting treatment: disclose, but not recognize, if the obligation is possible. Recognize only if the obligation is probable and measurable. Differences between assets and liabilities. In this course, we will be using aspect, assets, and liabilities in our table as shown. 1. Definition: resources owned or controlled, obligations to pay or perform. 2. Value: economic benefit inflow, economic resource outflow. 3. Nature: debit balance, credit balance. 4. Classification: current and non-current, current and non-current. Asset and liability valuation under IFRS/GAAP. International Financial Reporting Standards focuses on fair value and revaluation, whereas generally accepted accounting principles emphasizes historical cost. Revaluation model IFRS. Assets can be revalued periodically. Cost model GAAP. Most assets are reported at historical cost unless impaired. This leads to differing financial statements across jurisdictions. Real-life application and case study. Case study: a logistics company has the following: fleet of delivery trucks worth 10 million naira, depreciated annually, 2 million naira in accounts receivable, a 5 million naira bank loan at 10% interest, 1 million naira in taxes payable. Accounting view, trucks to non-current assets, accounts receivable, current asset, loan, non-current liability, taxes, current liability. Using accounting principles, the company prepares a balance sheet that reflects these components, enabling stakeholders to assess liquidity, solvency, and operational health. Common mistakes in asset and liability accounting: overstating assets, e.g., failing to record impairment, not recognizing contingent liabilities, incorrect classification, e.g., short-term debt as long-term, ignoring depreciation or amortization. These errors distort financial statements and may result in regulatory penalties or investor mistrust. Summary: this module covered the identification, classification, measurement, and recognition of assets and liabilities. Accurate accounting in these areas is critical for sound financial reporting, investor confidence, and business strategy. Whether you are assessing your company's solvency or planning for expansion, mastering the treatment of assets and liabilities is a non-negotiable skill.